day, everyone, and welcome to this webinar with Easy Equities Intellidex. Thank you so much for taking your time out of your day to join us, and I really hope you enjoy it. I'm Sean Keeling, and I'll be your host. There's been a lot happening in the world of ETFs, and a lot more happening this month. We have 3 new ETFs that are listing on the JSE this month. The first one is tomorrow, which is the Signia Artrix MSCI Emerging Markets 50 ETF. Then we have another one on Monday, the Core Shares Total World ETF, and then we have one later in the month from APSA. So it's really exciting, and enough about me just talking about ETFs. Today, we will be chatting with Phibion Makuwerere, who is a senior financial analyst at Intellidex, on the topic of hedging against inflation in your portfolio, which is really exciting because he'll obviously be explaining to us about how you use ETFs to do that. So enough about me chattering, and over to the clever guy in the room. Phibion, over to you. Enjoy, everyone.
Thank you, Sean. Good afternoon to you all. As Sean has highlighted, I'm going to be talking about inflation, which has become a topical issue lately in global financial markets, more so since yesterday. I know that a lot of books have been written on the subject, but I will try to be very brief so that we can have more time to discuss your questions. But it might leave, those inclined scholars wanting more, but that's how we're going to do it today. Yeah, thank you. Let's get it started. So these are some of the broad topics we'll cover in this webinar. So the discussion looks at causes of inflation at a global level, zeroing in on the USA a bit, given its relative importance in how the global economy works. As the saying goes, if the US sneezes, the rest of the world catches a cold. Also, the inflationary pressures in question, or we're going to discuss today, are arguably due to how the developed world, in particular the US, has conducted its economic policies since COVID-19 began. I will conclude by discussing some ETF investment options that are available to hedge against inflation, or that are likely to do well in an inflationary environment, or that are likely to be least affected by the market fractions. So let's kick off by looking a bit on the theory of inflation. Inflation is the rate at which the general price level of goods and services in an economy increases over time, as measured by the Consumer Price Index. For those of you who encountered economics in school, this slide should be quite familiar. It is just a recap. I will not get too technical here. The 2 broad causes of inflation are cost push and demand pull. The main difference being between these two being that it's usually the initial signal which determines which sort of inflation you are experiencing. In the cost push scenario, inflation is caused by a supply side shock, which has an effect on reducing aggregate supply and increasing input or production costs. Implied here in cost push inflation is that the demand side of things has not changed. Whereas in the case of demand pull inflation, the assumption is that nothing changes on the supply side of the economy, but prices tend to go up as consumers' buying power or purchasing power increases. Hence the popular phrase, too much money chasing too few goods. So given that background theory, let's look at what has been causing inflation fears in the global markets lately. In short, as I just mentioned earlier on, it's too much money chasing too few goods. The actions by both governments and monetary authorities globally, particularly in the USA, have put too much money in the hands of consumers, in this case, both businesses and households. Coupled with the vaccination rollout, it has seen a faster than expected recovery In the US, it is actually estimated that about 8 trillion has been added to the economy since last year, since COVID began. And about 5.3 trillion of this is fiscal support. So comparatively, this is multiples more in both relative and absolute terms than what was injected in the first year of the global financial crisis in around 2008, 2009. Also specific to COVID-19, unlike the global financial crisis, the fiscal dynamic here makes things interesting. Whereas monetary stimulus relies heavily on trickle-down economics, fiscal stimulus has a more immediate and direct impact, as we are experiencing now. The past 2 months, the US has reported inflation numbers that have surpassed expectations. The most recent one, a reading of 4.2% versus estimates of 3.6% for April, has definitely spooked almost everyone, and it has added fuel to these inflation fears. And people are worried that the economy is already, the global economy led by the US is already overheating. They say this reading from yesterday is the highest rate recorded since 2009. So you get the sense why people are worried today and why the markets are behaving the way they are behaving today. So on this slide, we look at some examples of worrying price trends that had been observed building to yesterday. While at a macro level, we have established that the main inflation driver in question is largely due to high demand. At a micro level, along the supply chains, some players are already experiencing cost push inflation. Specifically, if you look on the commodities, where the debate is still on whether we are in a super cycle or not. Where a super cycle is a period whereby commodity prices, usually due to high demand, rise above their long run trend for an extended period, usually more than a decade. And if it does turn out that we are indeed in a super cycle, the likely driver here is the transitioning of most economies to become more greener, more sustainable. Another example of demand pull is the chip shortages that are being experienced globally. Chips are an important input in the manufacturing of most electronics. Also in April, China recorded its highest inflation for manufacturing in years. I think it's in 3 or 4 years, partly due to rising commodity prices. And on the next slide, let's look at how commodities have performed since the beginning of the year to put that in context here. So as you can see here, demand has been strong for industrial commodities since the beginning of the year. And most of these commodities are inputs in production. Also, you can see that there's a stark contrast there with gold performance, which is usually viewed as a safe haven in times of uncertainty. So this shows that there is a high conviction and confidence that the economy is indeed recovering globally. Now let's look at how the monetary authorities have so far responded to these inflationary fears and pressures. The US Federal has accepted that we are bound to experience inflation in the near term, which is obviously a natural consequence of economy's recovery, also due to COVID-related base effects. But it does believe that the pressures are temporary and they will indeed pass. Also, its dual mandate was refined last year, and it now targets average inflation as opposed to just inflation and full employment. And the important word there is average inflation, which is different from its prior mandate. What this then means is that when employment is high, as is the case now in the US, it is what the Fed does is it focuses on high unemployment, and we can easily let inflation go above their usual target of 2%, as long as over time it averages out to 2%. But what has happened is some quarters of the market think that the inflation we're experiencing may not be as temporary as the Fed would want us to believe. And this dislocation has been a source of volatility in the markets of late, particularly yesterday and today. To understand the impact of inflation on asset prices, we need to introduce a new term, discount rate, or some people call it the cost of money. It's also known as the required rate of return by investors. This is a mechanism used to compare money that will be received in future against its supposed value today. So the higher the discount rate, the lower the value of future cash flows. Several premiums are usually baked into the discount rate, including inflation. So a simple explanation is that as inflation rises, the discount rate also rises. Or alternatively, what will happen is that if inflation proves to be stubborn and sticky, the Fed's end might actually be forced to raise interest rates, as well as to mop up excess liquidity in the market to tame these inflationary pressures. If this does happen, it means cheap money is no longer available, and competition for limited capital will raise interest rates and by consequence, will raise cost of capital or the discount rate in this case. When future cash flows, such as dividends, are discounted at a higher rate than before, what usually happens is asset prices fall. In this case, equity prices tend to fall. And this is why inflation is uncomfortable for investors, as it reduces the value or the purchasing power of future cash flows. So how does all this affect South Africa? I've managed to come up with 3 scenarios here that are likely to play out. And this is quite related to the previous slide on discount rates. So the scenario A is when inflation rises, global interest rates are also likely to rise as a result. And what that means is SA and other emerging markets become less attractive, and international investors tend to sell off our SA assets or emerging market assets, which means that the price of equities and bonds will fall in South Africa. And also the rand tends to weaken. The scenario B, which is probably the most immediate one, is we find ourselves importing expensive goods as goods that are used into production in our own production processes here in South Africa. So for instance, the price of machinery or oil goes up. In scenario C, usually it's in response to scenarios A and scenarios B. What does happen is that we might end up raising our interest rates in South Africa, sort of because we want to re-attract foreign capital. And this then means that demand becomes very low in South Africa, which again stalls our own recovery. So how can investors use this knowledge? I think there are 2 approaches or 2 ways of thinking about the situation that we are in. So the first approach is to invest in assets that track inflation well. So this could be assets whose principal value is indexed to inflation, or assets that can pass on cost increases to consumers, or assets whose product prices track inflation well. Scenario B is is you have noticed that the market volatility has increased since yesterday, particularly yesterday, but yeah, it has been increasing for some time ever since the inflation worries started to appear on the market. So you might want to counter that by investing in an anti-volatility asset. So using approach A here, this is my first option. You would probably want to consider investing in an asset that track inflation well. If you invest in inflation-linked bonds, the way it works is that the principal of an inflation-linked bond is regularly adjusted by the latest inflation rate measured by the consumer price index. So the principal value rises over time. And simultaneously, investors receive a regular coupon payment, which is based on a higher principal. So what that means is that the value of the interest that you receive from a higher principal also increases. So that's one way of looking at it. So if inflation is expected to increase as the situation has been of late, you see that inflation-linked bond prices will be bid upwards by investors. The other side, however, of this argument is that if expectations for expected for lower inflation, it might be more beneficial to hold other assets or even perhaps nominal bonds or other equities. Yeah. However, this doesn't mean that returns from inflation-linked bonds is a linear function of inflation. While inflation is a big factor, there are other forces that influence the price of an inflation-linked bond, such as credit ratings of the South African government, which haven't been great of late. Thus, the price for inflation-linked bonds tend to fluctuate, reflecting all these moving variables: inflation, credit ratings, interest rates, and the like. The Satrix ILBI ETF is the cheapest among its peers with just a total expense ratio of 0.25%, making it an ideal vehicle to gain exposure to investments that protect you from against inflation. And let's move on to the next option. The next one, again, it's based on approach A. In this case, it's investing in assets whose product prices track inflation well. In this case, demand pull inflation. To take advantage of the resilience of commodities when it comes to demand pull inflation, the Satrix Resi is where you might actually want to be. It is the only fund on JSE giving exposure to mining companies. And a recent survey conducted by HSBC shows that investors believe that the strength shown by commodities is not yet fully reflected in both economic and company performance numbers. So likely there's more upside to be had if you do choose to go with Satrix Resi. Again, with more stimulus plans on the cards relating to infrastructure, particularly in the US, also motivated by transitioning to a greener economy, global demand for commodities is looking up. And prior to this trend that we are seeing now, what has been aiding the commodity boom are also supply chain fears is producer countries, which are predominantly developing countries. They are either underinvested or poor investment destination. So plus also the risk of future COVID waves still is there in emerging markets which are the biggest suppliers of these commodities. Given that vaccination programs in these countries have really lagged behind. And The Eurozone and China have driven resources for quite a while. But now if you add the US in the mix, you see why the demand for commodities is quite appealing. Also, Bloomberg forecast that demand for metals such as copper, lithium, iron, nickel, and the like will grow more than 10 times in the next decade, which feeds into the super cycle narrative. The last one that I have on the radar is based on approach B, where you invest in anti-volatility assets. This fund is ideal when you are worried about market volatility as we're experiencing today and also partly yesterday due to these inflation fears. The fund gives exposure to about 20 JSE listed securities that exhibit the lowest volatility, as well as low beta, which is stock sensitivity to overall market movements. The fund selects 20 stocks with the lowest standard deviations and betas from a pool of 60 most liquid JSE listed shares to form the portfolio. And the fund, again, is weighted by volatility. So you've got two filters or criteria which all use volatility. So it's should turn out to be a very less responsive to market movements. The fund is appropriate for investors who are more risk averse and might be inclined to panic during a market correction. The fund is likely to provide better downside protection as it is less eruptive when compared to the overall market. But the caveat is that this fund tends to lag in strong markets by nature because it doesn't respond well to movements in other assets or in movements in the market. So you generally are expected to earn, comparatively to other strategies, might not earn absolute terms, the return might not be very attractive. But in terms of risk-adjusted returns, it generally tends to do better than the overall market over time. So how does this volatility fund stack up against the all-share index and the top 40? What you see there is that it is indeed, in terms of risk, it's lower than both the all-share index and the investable top 40 index. But it has performed poorly in terms of returns since its listing 3 years ago, as you can also see there. So I was hoping to finish this as quickly as possible. And this brings me to the end of our webinar. And I'm happy to take your questions. Back to you, Sean. Thanks.
Thank you so much, Phibion. Look, it shows that there's lots of uncertainty around inflation, but thank you for giving us also some ETFs to look at with it. I do see there are some questions in the question and answer box. If you do have any other questions for Phibion, please put them in there. But Phibion, if you can start looking at those ones in there. Okay.
So sort of a comment and a question at the same time. So from Stevie here, I don't believe too much money is in the hands of consumers. Sorry, I don't believe that if too much money in the hands of consumers causes inflation. If this is unspent, it will become savings. Surely inflation would only okay if increased demand happens. So, yeah, it depends on how you are looking at it. So as you notice that throughout my presentation, my focus was on the developed market, particularly the USA, because that's where the inflationary fears or pressures are emanating from. And if you look at how the American government has conducted its policy, particularly the fiscal policy, where it has given people checks, We have a lot of people with a lot of savings and a lot of buying power. And even the reading that came out yesterday, that 4.2%, most of it was in areas where consumers have got a lot of say in terms of demand. And for that reason, some of it is expected to be transitory inflation. But if you look in South Africa, of course, you see a scenario because we've performed really poorly as a result of COVID. So people are not as saved up as you have them in developed countries where the governments have got those social safety nets in the event of unexpected negative influences on their economy. Again, where would increased inflation, it's actually from the same person, Phibion, where would increased inflation in SA come from? Consider job losses, business closures would result in decreased demand. Would it come from imports? Yeah, so that's sort of what I've highlighted. Remember, I brought 3 scenarios of how that could affect us. So most of it is actually imported through either very, when we do import machinery into our production here in South Africa. What it does mean is when you import it at a higher price, obviously manufacturers will be forced to pass that on into the system. So that's where it would come from. But for South Africa, or emerging markets in general, I think the real issue here is how inflation influences policies in developed markets. So as I mentioned in the presentation, that what might happen is that the Fed might be forced to raise interest rates. What then happens is that you have a scenario where our assets are sold off in South Africa. And as a result, you see things such as the rand losing its value. And also generally it's bad for our economy when we don't have enough capital to invest in the system as investors pull out. So this question, how can investors who are willing to take on inflationary risks try to benefit from an inflationary environment? So as I mentioned that there are companies, so you look at, there are different scenarios, but the scenario where you might want to take on additional risk due to inflation is where you look for companies that have got capacity to pass on the inflation to consumers. For instance, the fund that I had in mind is the Satrix Resi, because it's demand pull and prices of commodities are going up. We expect that this is a direct benefit to commodity companies, to miners mostly, and that should reflect at the bottom line in profits and in dividends being distributed to shareholders. Which SA companies mine cobalt? So we, in South Africa, most of our miners predominantly your PGMs, but if you look at, there are other more diversified miners with operations all over the world, where cobalt and lithium are mined. So for instance, if you look at, I'm trying to remember it off the top of my head, which has got operations in DRC. It's one that you can consider for if you want to take, if you don't want to take on the ETF, but as an individual miner. You can look at, I think it's BHP. Yeah, I think so, yeah. So okay, let me check this one by Gladwell. So with the fear of third wave coming, what do you think will happen to inflation in SA? So as I mentioned that in SA, our worry or our outlook, I know our economics at Intellidex still think that our inflation is nothing to really worry about in the short to medium term. because of lower demand, particularly at the core level. But the focus of our presentation was how inflation in global markets will affect South Africa. It's not so much about what sort of the inflation levels are in South Africa, but what global inflation will do to asset prices in South Africa, to cost of imports in South Africa to the rand. And then those things now then tend to affect our economic growth, et cetera, et cetera. Yeah. There's a strong rand drive away investors. So it really depends on how you want to approach it. So the rand is generally been used by a lot of investors as a proxy for what's happening in emerging markets. And because South Africa as an emerging market is one market which has got deeper markets, so it's easier for investors to come in and out. So it's something that they do consider when they invest in South Africa, the strength of the rand. So if they do see the rand strengthening, perhaps in the short to medium term, and when at the same time our yield is high, investors are more likely to come in because it's a double benefit for them. So, like I said, it's just how they want to play it out. But generally, you'd prefer a rand which is more stable. Investors generally prefer a rand which is more stable, if I put it the other way. What foreign currency would you buy to hedge inflation? The US dollar or the Swiss franc? So I'm not really a currency expert, but generally what you tend to see is that the investors from empirical or even anecdotal evidence tend to treat the Swiss franc as a hedge, unlike the US dollar. Because the US dollar tend to lose value during booms, and unlike the Swiss franc, it generally tend to be stable and more resilient. Yeah. This is similar to the question that I've just answered. Which currency do you think will hold up best against the backdrop of global inflation? So obviously, again, you're looking at developed markets, and currencies such as your Japanese yen and the Swiss franc that has just been pointed out by one of the listeners here. But I'll put a disclaimer that I'm not really a currency expert. I would rather focus on equity ETFs. Yeah. So Annabelle says, you mentioned that in the global context, in the global context of inflation, the rand would weaken. Currently, we are experiencing an astonishing recovery of the rand. How do you explain this trend? So you're correctly right. Your assertions are right. So what has caused the rand to strengthen has been nothing really to do with our economy per se, but we have experienced this commodity boom. Prices have performed really well. So South Africa being a commodity-based economy, we have seen a lot of Forex coming into the system, which has strengthened their rand. And also the government has performed much better than feared in terms of both expenditure and revenue collection. So that is added up to the rand strength. So given that scenario, what has then happened is that the rand, of course, has strengthened. But and we think that is a very short-term scenario, as you look over the medium term, and if you look at the outlook that we have on our government finances, most likely you have a scenario where the rand is strengthened for a bit of time, particularly in the immediate term. But then in the medium to longer term, it will respond to poor performance by government in terms of our fiscus and finances, which will weaken it. So if you want to invest offshore, it's actually a very good time to do it, given that the rand is quite strong. Okay, so another one here from Brent. How do you pick your ETFs? So what we do really is sort of a two-pronged approach. So where you've got the top-down approach, where you look at the macro, at a macro level and see what things are playing out. For instance, at the moment, the thing that's really playing out in the markets is inflation. And also you take the bottom-up approach and look for individual ETFs that seem to play well given the global backdrop that you are in at the moment. So basically, that's really how we go about it. So can you explain why copper and other hard commodities would benefit from inflation? So yeah, this one, you have to look at it with a bit of suspicion, because there's always sort of like an egg chicken kind situation where you ask yourself what really causes, is it commodities causing inflation or inflation causing commodities to strengthen? So, but in the situation that we are in, where there is a lot of demand for them, what's happening is that they are responding to inflation. But as the price of commodities continue to strengthen, they will become a bit of a problem now as an input cost, because it's at a higher price point, which makes that conversation of cost push, demand pull sort of conversation bled a bit. So how would this type of inflation affect the housing market? Because here the focus was really on global inflation rather than the South African inflation. The transmission mechanism that I explained in my presentation is that interest rates will rise globally, which makes our assets less attractive. And we will also be forced to raise interest rates. So when that does happen now, the housing market might actually face pressure due to rising interest rates, which kills demand. So it's one area, it's one way of looking at it, but there are other forces at play. Yeah. Again, would you see an increase in the interest rate? So I've just explained that. So if inflation turns out to be more sustained than what sort of the likes of the Fed are saying about it being temporary, then yeah, there is a strong case for interest rates to rise, which is why there's that disagreement between the Fed and some sort of segments of the market who actually believe that this inflation could be more sustained than the Fed thinks. Yeah.
Are you going there, Phibion? I think we'll end it shortly, so maybe just one more, and then we'll go from there. I know there are a few more questions, and we'll get a list of them and try to respond to them afterwards. But we've had quite a few there.
Yeah. So here, money market funds are said to benefit from higher inflation because of increased monetary intervention in the face of higher inflation. Would you recommend an investment portfolio which is a mixture of ETFs and a monetary fund? Or would you recommend one over the other? Yeah, so part of the question is not quite clear, but I suppose reading the first bit of your question, you want to know if a money market fund is, is a good investment when inflation is high. So again, it really depends on how these things tend to play out and your thesis around, your reasoning. So a scenario where there's very high inflation, but interest rates are low, then that won't be a very good investment in such a scenario. But in a scenario where the interest rates are raised much higher than the inflation you're experiencing, you will tend to earn a real return. So again, it's really based on how you look at the variables and how you think they will play out.
Great, thanks, Phibion. I think we'll call it there. Like I said, we'll get the question log and answer, and we'll send responses back to the respondees that we didn't get to their questions. But thank you so much for the presentation, Phibion. It was really interesting and very insightful. And thank you to all of you for joining us today. I hope you really enjoyed it and learned a lot from Phibion, as I always do when I listen to him talk.
Thank you, Sean.
So easy, so easy.